So far, we've discussed the dividend policy when the markets are in equilibrium, no friction, no costs. In effect, the markets are perfect. However, in the real world, markets are imperfect, and because of this, dividend policy might be relevant. Because of the agency relationship between managers and shareholders, the agency cost or the contracting model proposes that firms pay dividends in order to reduce agency problems. Instead of using cash flows for perquisites, making bad investment decisions, or hoard excess cash, managers pay out this cash in the form of dividends, thus reducing the need for shareholders to monitor the managers. Investors understand the temptations that managers face, and when the firm decides to pay dividends, they take it as a good news which will lead to a share price increase. Accordingly, the model predicts that firms with high excess cash flows will pay high dividends. The data supports this, as based on ownership structure, we see that big firms have higher payouts as opposed to private and small public companies who rarely pay dividends. The agency problem will be higher for big public companies, and to overcome that problem, management pays dividends. Similarly, mature companies have higher dividends compared with high growth companies who retain all their funds for expansion and growth. The other reason why dividends are important is that they provide signals to investors about the firm. Due to the information asymmetry, managers know more about the company than the investors who put money in the company. And because dividends are so important to shareholders, any information released from management related to dividends and dividend policy, it's a signal to shareholders about the health of the firm. Accordingly, whether there is an increase or decrease in dividend, it will have a corresponding effect on the share price. This is called the information content effect or the signaling effect, because the market reacts to changes in dividend payout. An anticipated rise in dividends, all things equal, is often treated as good news by investors, because it indicates management's confidence that the company's prospects are improved enough to pay these higher dividends into the future. An increase in dividend is the management's signal to the market that the firm is doing well. The share price often reacts favorably because expectations are raised upwards, meaning that the present value of the share increases. Similarly, since in the past investors have often reacted badly to unanticipated cuts in dividends, shareholders know that the board would not lower dividends unless the management thought the company has a reduced capacity to pay dividends in the future. This negative news thus often leads to a fall in the share price. There are some real-world factors that make the dividend policy relevant. So in real life, we do have taxes and other costs. And because of these, sometimes companies and shareholders prefer lower or higher dividends. A low payout might be desirable for individuals when they are in a higher tax bracket. They don't want to increase their taxable income given that they have to pay more tax on it. Rather, they would desire an increase in capital gains. Having said that, we know that in Australia we have the dividend imputation system, which prevents the double taxation of dividends. For companies, if they pay low dividends, they don't have to raise large amounts of capital to use in the new projects. Therefore, less capital raised, less share and bond issue costs. At the same time, companies might have restrictive debt covenants which specify or limit the amount of dividends they can pay out of income. For example, if a company has issued bonds in the past, one of the conditions of lenders might be to have only a certain amount of earnings paid to shareholders so that enough remains to cover interest payments. Now, we said that in Australia we have this dividend imputation system that prevents the double taxation of dividends. This system has been implemented in Australia in September 1985 and was welcomed as it gave some relief to investors by allowing them a tax credit on dividends received as a result of the tax that was already paid by the company. These imputation credits allows investors to reduce their overall tax liability on income, whether this income is from dividends or from other sources. Therefore, the most desired dividends are the franked dividends because the company has paid tax on them. In Australia, the company tax is 30%. So when a company declares dividend on which fully tax has been paid, we call them fully franked dividends. Given the 30% tax rate, this means that for every $7 in dividends, there is a tax credit of $3. Dividends can also be partially franked, meaning only a portion of tax has been paid on them, or unfranked, where no tax has been paid. Historically, the main tax systems are the classical or double taxation tax system, which is applied in the United States, and the imputation tax system, which is applied in the UK, New Zealand, and Australia. In the classical system, net income is taxed first at the company level and then is taxed again at the shareholder level. The effect is that dividends are taxed twice, and the effective tax rate is high as a result. Therefore, there is a disincentive for all shareholders to receive dividends, and they may instead favor share dividends and buybacks. These are some examples on how the imputation system works on various levels of taxable income and their associated marginal tax rate. As we said, for every $7 in dividend received, the shareholder gets $3 in credit. So in our case, if the dividend received is 70, let's look at column 1, tax credit is $30. The way the imputation system works is that the grossed up amount is included in the assessable income. The grossed up amount is calculated as dividend divided 1 minus 30%. The tax paid on this grossed up amount is calculated using the marginal tax rate. So because we have a tax credit of $30, we can reduce the tax paid. And for the low income earner in the column 1, they can actually get a refund of $11. There is also a case for a high dividend payment. A higher payout might be favorable in 3 instances. The first is when there is a desire for current income. This will apply to individuals that are in need of immediate funds, such as retirees or other people on fixed income. In a world of transaction cost, implementing a homemade dividend policy by buying and selling shares can be costly in terms of brokerage fees. Similarly, various businesses entities such as trusts and pension funds may be banned from spending capital, therefore cannot create a homemade dividend by selling from existing shares, and some of these funds are prohibited from investing in companies that pay low dividends in the first place. In this instance, shareholders in low tax brackets such as superannuation funds, prefer dividends income and use the tax credit to offset tax liabilities elsewhere. The second instance has to do with uncertainty resolution. According to Gordon, 1961, investors prefer a high dividend policy because it resolves uncertainty. In this theory, it is argued that investors value a stock by estimating and discounting future dividends, as we know. Therefore, forecasts of dividends to be received in the distant future have greater uncertainty than forecasts in the near future. Better to have high dividend now. The third instant has to do with taxes. And yes, we said previously that taxes favor a low payout. However, when companies become shareholders in other companies, the dividends received are taxed at a lower rate. Thus, the shareholders' companies received an enormous tax deduction. The other case is when investors are exempt from paying taxes. Depending on the country, some pension funds or trust funds are completely exempt from paying taxes. Because their income is tax exempt and don't have to worry about paying taxes, of course they want higher dividends. In Australia, funds do pay tax, but at a lower rate. For example, the superannuation funds pay 15% tax only. Observation on the market suggests that companies have long-run target dividend payout ratios. And companies change their dividends based on changes in the earnings that are sustainable over a long period of time. Managers don't want to increase dividends if they might have to decrease them later. This appears to be a bad signal to investors who value consistent dividend policies. All this relate to the dividend signaling model, where the market does take in consideration increased dividends as positive news and dividend cuts as bad news. The evidence has shown that taxes influence payout policies to some extent only and do not prevent companies from paying dividends or repurchasing shares. These are some results from a survey as to the CFO's decisions regarding dividends and share repurchases, which shows that managers strongly believe in the signaling model, where distributions decisions convey information about the company. And they consider cutting dividends as having negative consequences to the company, in contrast with share repurchases, which are considered more discretionary and don't have such an impact on the market if they are reduced. This is further evidence on share repurchases and the motives behind engaging in such practices. The majority of managers believe the share is undervalued, and that is the reason why they engage in share repurchasing. Similarly, a large proportion believe that if there are no investments out there to increase the value of the firm, then it is better to pay shareholders in the form of repurchases. Others say they do it because they want to increase the earnings per share and to offset stock option dilution. This concludes Module 10.